Hi, this is Dan. A lot of people, especially older people in their 60s and 70 years old, are feeling the effects of inflation. Unfortunately, a lot of them cannot go back to work, so kind of stuck. Fortunately for some, they own their homes, and a lot of them, unfortunately, own their homes outright, and especially places like California, where they could be sitting on $1 million home. However, they're kind of financially strapped. In some instances, they don't want to sell their home. They like it where they're at. They're probably friends and family, and they just don't want to move. Now, the issue is, how are they going to get the money out and live, especially a comfortable life? Well, one very popular option is the reverse mortgage. Now, reverse mortgage, as it sounds like, is a reverse. Instead of you having to pay the bank pays you. And you have to be 62 years or older, I believe, to qualify for a reverse mortgage. Now, again, so you own the home, it's $1 million home, and let's say you own it outright. So every month, the bank will cut you a check. Now, it's actually not building equity, your equity is going down. That's why it's a reverse. Now, this is an option that many people want to do or forced to do in some circumstances. But there's also some other options. For instance, a HELOC. Now, a HELOC is a home equity line of credit. Now, this is usually a variable interest rate, and you only take the money that you need out. And it's just kind of like, some people call it a line of credit, I imagine. You can do that. That can be called that also. But a HELOC, nice about that is you can just draw into it. So if you don't need it, you don't have to take it. Now, the third one is a home equity loan, sometimes referred to as a second. Now, this is usually upfront. So, for instance, you own that $1 million home, but you only want to tap in, let's say, $200,000. So you take the $200,000, let's say you take it for 10 years. So each year you take $20,000 a year for 10 years. That would be $200,000. So that's what you take from that. You can just take it from there, or they'll give you the $200,000. You keep it in the bank, and then you'll draw from that each month. It's usually a fixed rate, where the HELOC is usually variable. And it's great with the variable when the interest rates are low. But unfortunately, as we're experiencing right now, the interest rates are rising. Now, there's also another one you can do, cash out refi. When you cash out refi, you're replacing your existing mortgage and you're taking the money out. So for instance, you own that $1 million home. You take $500,000 out, okay? But you had a 3% loan, now you have a 7% loan, so it's going to be paying on it, unfortunately, in today's rates. But you get the $500,000 out, and then you can live on that money. That's another option. Another option is a sale-leaseback agreement, where you can probably sell the home to an investor who will allow you to rent it from them. Now, this is good for people that just don't want to lose or leave their home, or possibly a family member. Let's say you have a son or a daughter that want that home. It's probably easier to do it now while you're still living, to avoid places like probate and other court litigations that you might have to experience. Now, just remember, every situation is different. It's unique. So you want to speak with a financial professional, possibly a tax person or a real estate professional, to get the best advice and make the best decision possible. Well, thank you very much, and please like and subscribe in the comment section below. Thanks a lot. Have a great day.